But let me first introduce our keynote speaker of the day, Marc Bayle. He is now the Chief Executive Officer of CLS, the biggest payment system in the world. Before joining CLS, Marc spent 20 years at the European Central Bank. From 2014 to 2019, Marc was Director General, Market Infrastructure and Payments, and Mehdi Mana, the CEO of Buna, who spoke yesterday, was its deputy. As some of you know well, from 2009 until 2014, Marc and Mehdi worked with me at the ECB on one of the most important infrastructure projects in Europe, the security settlement platform called T2S. Now Marc is based in New York and Mehdi is based in Abu Dhabi. But the payments world is small. Marc, the floor is yours.
Thank you very much, Jean-Michel. Very nice to be with you today. Thank you for this kind introduction. A lot of good souvenirs all together. Thank you to Currency Research also to give me the opportunity to speak in this Central Bank Payments Conference this year. It is a good year, I think, for us to come. Under normal circumstances, we would be around probably some more possibility to socialize and to have a good time around Cape Town, I remember, was the destination of the year. Maybe will be possible in another year. We have now to be virtually connected and get used to it with this new context in which we are. And very happy to be able to exchange now with the distinguished guests which are coming to your conference, as well as former friends, former colleagues, as you mentioned, and the whole central bank community, which is really core to what CLS is, for what it has achieved so far, as well as what he wants to do for the future. As you know, CLS was created in 2002, so 18 years ago, through an unprecedented partnership between the industry and the central bank community. There was a clear common objective, which was to mitigate a risk, the FX settlement risk, in fact, that had already materialized in different ways, with in particular prominent bank failure, which were active in this market, like Erstadt, BCCI, or Barings Banks, just to mention a few names, and which led to widespread panic, I would say, in the financial market, because spreading over their default in different market segments, different currency. Also, the launch of CLS reduced the amount of FX settlement risk in the market in 2002. There is evidence that today the FX settlement risk is on the rise again, and maybe reaching, in fact, level that threaten the global financial stability, particularly if a large market participant were to encounter distress or, in a worst case scenario, fail outright. So I strongly believe that the time to address this growing risk is now. We should not wait. We should simply see and face what type of challenges we can bring should a large bank fail or a market event would roll out, and what type of action we would have to take. Today, I am calling, in fact, the industry and the regulatory community to create a new private-public partnership like the one that created CLS some 20 years ago, as I was mentioning, to promote the adoption of PVP settlement and to find a solution for currencies not currently eligible for PVP protection. Before outlining my views on this new partnership, I think it's important to first provide a brief history of the FX settlement risk and CLS origins, explain the new evidence suggesting FX settlement risk is increasing, outline known obstacles to CLS currency expansions, and highlight CLS efforts to promote PVP adoption and its thinking on a solution for non-CLS currencies. So to begin with, if we are not part of the FX settlement ecosystem so far, you may be wondering why the settlement risk for FX is still increasing, and why is it so important to find mitigation to this financial stability issue. Simply put, the FX settlement risk is a risk that one party to an FX transaction will pay the currency it sold, but not receive the currency it bought. Because many currencies are paid at different times of the day, there could be a big timing gap between the payment of one currency and the receipt in the counter currency. Here, on the slide, we have an example of a failed bilateral trade where Bank A pays euros to Bank B and is expecting US dollar to return. However, due to an issue at Bank B, let's say an operational failure, Bank A does not receive the US dollar it is expecting. Further, Bank A already sent an equivalent amount of euros to Bank B. Such missed payments are typically made the following day with appropriate compensation. But what if Bank B collapses and Bank A loses the full amount of the principal? Such a loss of principal may be manageable if the amount is small, but the problem is that in today's FX world is anything but small. Recent estimates from the BIS suggest that there is an equivalent US dollar of 18.7 trillion of gross FX payment obligation every day. So worse, a single failure could lead to a domino effect where an institution not receiving funds is unable to make payments to other banks, leading to a chain reaction to spread losses throughout the financial system. FX settlement risk is not a new issue on the regulatory agenda. The central bank community has sought ways to mitigate FX settlement risk to avoid a repeat of a widespread panic, freezing the interbank lending market, and distrust in interbank relationship experience following a bank house Erste collapse in June 1974. During the 80s and the 90s, the CPSS, the Committee on Payment and Settlement System, now called CPMI for Committee on Payment and Market Infrastructure, carried out extensive research on analysis on FX settlement risk mitigation. During the same time, several notable bank failures placed urgency on the need for a solution. What many does not realize is that CLS origin could be traced back to the recommendation outlined in 1986 CPSS report, calling on industry groups to develop multi-currency settlement and netting arrangements. Further, the central bank community was to show its support of industry initiative and corporates in these groups to ensure timely and market-wide progress. With this recommendation, the public-private partnership responsible for CLS creation was born. 20 major financial institutions formed the group with support from the central bank community, refined the link settlement concept or payment versus payment, PVP, that remains in the heart of CLS settlement systems today. The next visual demonstrates that PVP settlement and its mitigation, risk mitigation benefits. So the next visual demonstrates PVP settlement and its risk mitigation benefits. PVP ensures the final transfer of payment in one currency occur if and only if the final transfer of the payment in another currencies take place. With PVP, Bank A does not experience the same loss of principal as in the failed bilateral trade. It knows that its trade will settle in CLS with significant risk mitigation provided by this PVP mechanism. It is because of the strong public-private partnership that CLS launched in 2002 with 39 settlement members and 7 currencies it services. Fast forward almost 20 years, CLS is now systemically important FMI, settling on average about 6 trillion of dollar equivalent of payment instruction per day. Funding is determined on a multilateral netted basis, thereby reducing the amount of liquidity required for settlement by approximately 96%. Our membership comprises of over 70 of the world's largest financial institutions. Approximately 28,000 participants, indirect participants, primarily buy-side institutions, access CLS via our members. We currently are settling 18 of the most active traded currencies in the world, with a plan to add the Chilean pesos, our 19 currencies, to our system in 2022. Further to the 18 central banks whose currency are settled in CLS, plus 5 other Eurosystem central banks, have established the CLS Oversight Committee, a formal cooperative oversight arrangement coordinated by the Federal Reserve Bank of New York. This OC, Oversight Committee, is utilized to avoid duplication of effort by central banks in the different locations and foster consistent and transparent communication between them and CLS. It enhances also the transparency regarding applicable regulatory policies in CLS jurisdictions. It's a very strong, I think, asset for CLS to continue to grow in the FX settlement risk space. You may be thinking, great, CLS has these FX settlement risk problems solved. Unfortunately, the solution to FX settlement service is not that easy. On the contrary, recent data published by the BIS, by central banks, suggests that FX settlement risk is on the rise. Of the equivalent of $18.7 trillion of daily gross FX payment obligation, 8.9 of those trillion of equivalent dollar are settling without PVP projection, and therefore may be at risk or creating risk in the market. The BIS data also suggests that the proportion of trades settled with PVP protection has decreased from 50% in 2013 to 40% in 2019. Further, settlement risk is not only increasing for currencies that are not settling in CLS. These include currencies like the Chinese renminbi, the Russian ruble, and the Turkish lira, but might be increasing for currencies that are eligible as well for settlement in CLS. Your immediate reaction is probably why. To elaborate a bit, why are the CLS eligible trade not settling in CLS, and why is there no global solution for key emerging market currencies? These are some questions that CLS, the industry, and the regulatory community are now taking steps to answer. Let's start with the first question. Also, settlement risk is measured by gross payment obligation, i.e. the actual payment that come out of a trade. For comparative purposes, the market looks at traded notionals. All the references provided from this point are based on trade volume as measured and reported by the BIS and CLS own data. CLS conducted its own analysis and concluded that the total daily volume of CLS eligible currency equates to about 5.34 US$ trillion equivalent. CLS settles 31% of those eligible transactions, which means that 69% of transactions in CLS eligible currency are not settling in CLS. Our analysis suggests that approximately 31 of the 69% are traded not usually sent to CLS, such as related party trades or trades between two legal entities of a global bank and give-up trades of prime brokers. The remaining 38 of the 69% may be eligible for CLS settlement, but the BIS data lacks granularity needed to make an eligibility determination for those transactions. Such trades could include internalized, low-value corporates, retail, and same-day trades. For CLS, this remaining 38% is our core area of focus. And we are in the process of reviewing the trade data of one of the largest settlement members to better understand what CLS eligible trades are and are not settling in CLS, and for what reason. Going back to the second question, but what about currencies not eligible for settlement in CLS? The BIS data suggests that emerging market currency volume equates to $1.25 trillion equivalent in 2019, roughly as large as the entire FX market in 2001, which was $1.2 trillion equivalent dollar, just prior to CLS launch. Further, growing FX settlement risk should not be a concern to only emerging markets. Central banks of developed markets should take interest in growing settlement risk in non-CLS currencies, as those currencies are traded globally with G10 currencies such as the US dollar, the euro, on the other side of their trade. As a result, any failure in these trades could impact the entire financial system. This is visually demonstrated by the following slide: the top 10 currency pairs, followed by the top 35 pairs, where a non-CLS currency is on at least one side of the trade. The harsh reality is that many countries seeking PVP protection may not be able to obtain it under the current regulatory regime applied to FMIs offering such services. For example, few remaining currency can meet CLS currency onboarding standards, such as systemically important FMI derived from the PFMI, Principle for Financial Market Infrastructure, other applicable regulation, and CLS own standards. Principle 1 legal basis and Principle 8 settlement finality are presented the largest obstacle on onboarding new currency to CLS settlement system. In case of Chilean pesos, CLS resumed talks with the Banco Central de Chile upon the passage of Chile's settlement finality legislation. Passing new legislation to pave the way for CLS onboarding is not an easy task, and not all jurisdictions will be able to or have the political will to enact such changes. The Central Bank of Chile should be applauded for its effort and commitment to join the CLS ecosystem. So where does this leave the industry and regulatory committee in solving this growing risk to financial stability? Since the publication of the BIS quarterly review in December 2019, CLS has taken several steps to promote awareness and growing FX settlement risk and support further PVP adoption. Our strategy has three short-term objectives. First, to educate key stakeholders about growing FX settlement risk. Second, to strengthen the FX global code. And third, to advocate for better high-level, high-quality data collection via semi-annual turnover surveys of regional foreign exchange committees. I am pleased to say that a number of central banks, as well as CLS Oversight Committee, have expressed support for this effort to date. Specifically to our first objective, education, we recently published a white paper on our website entitled Unsettling the Increase of Foreign Exchange Without Settlement Risk Mitigation. The paper is a great primer, as we wrote it assuming much of the industry and regulatory community may not know about FX settlement risk or its growth in the recent year, CLS and the systemically important PVP settlement system, the obstacles CLS faces with respect of currency expansion. Additionally, CLS has been invited to present the Global Foreign Exchange Committee and several regional FXCs on this topic. We hope to build new relationships with emerging market local FX committees and other central banks whose currency do not settle in CLS. For those listening today, please feel free to reach out to me or perhaps the currency research team after the conference, who can make the connection. We very much welcome your engagement. Shifting to objectives 2, strengthening the FX global code, and 3, improve data collection, we are encouraged by the GFXC leadership in these areas. We believe that Principle 35 and 50 of the global code, the settlement risk principles, should be strengthened to better promote the use of PVP settlement mechanism. Should PVP not be available, risk management practices and control, for example, binding settlement limits, should be in place to mitigate remaining FX settlement risk. The GFXC also stated it would engage its new FXCs to consider ways to leverage the semi-annual turnover surveys to obtain better understanding of trends in settlement activity. Any new solution that mitigates FX settlement risk will greatly benefit from effort to obtain an improved picture of current FX settlement practices. CLS has started to formalize its view around a solution for non-CLS currencies. At the foundational level, we believe a degree of agile and flexible thinking is required. The solution may take as much different shape to ways CLS is today. A new different solution does not necessarily equate to throwing security or proper risk management practices out the window. Instead, any new solution should be viewed as an opportunity to remove FX settlement from the global market. Here are just a few key questions that require further debate by the industry and regulatory committee. What is the optimal model type? As mentioned earlier, CLS multilateral, strictly standardized and centralized settlement finality model is not attainable for many currencies. Where multilateral netting cannot be achieved, a bilateral netting solution with PVP settlement would still provide a degree of liquidity benefit and be hugely valuable in mitigating FX settlement risk. To that end, CLS has created a bilateral netting service for these currencies called CLSNet that may be starting point for a solution that includes PVP settlement. Should CLSNet serve as the initial building block, you could have a series of tailored PVP settlement systems with groups of 2 or 3 countries with a strong currency and economic ties. Such an approach would increase PVP adoption in parts of the world that currently do not have access to it. What is the appropriate account type? CLS has accounts with each of the 18 central banks, 19 with the Chilean peso soon, whose currencies are part of our system. Our settlement members pay and receive funds via central bank accounts. Many emerging market countries recognize CLS as a foreign entity, and as a result, CLS would need to leverage third-party banks in these countries to enable any transfer of funds. Our account could be identified in the book of the central bank, but the account would not be in CLS name. If such an arrangement is not possible, CLS would need to utilize commercial bank to hold and secure funding. What are the structures that will achieve acceptable finality? I find that discussions on settlement finality often invoke a feeling of fear and dread, and particularly with central bankers. The centralized mean of achieving finality, which equally recognized by all participant jurisdictions, is necessary for a multilateral and systemically important FMI like CLS. Any country wishing to join CLS, as noted earlier with Chile, would need to adjust their domestic rules or legislation to align with CLS standards. However, outside of CLS, finality exists in most countries' payment system and may provide a basis to achieve finality in each currency without resorting to a centralized standard. For example, if a new bilateral PVP solution is created between the US dollar and a non-CLS currency, you could rely on the rules of those 2 countries independently, provided a degree of simultaneous settlement could be achieved. Should there be simultaneous settlement and adequate legal certainty, you could then align to the existing laws of those jurisdictions rather than wait for a change in domestic rules or legislation. What type of standard would apply to a new solution? Existing standards such as PFMI apply to PVP settlement mechanism like CLS are appropriate for the systemically important role that these firms in the global play in the global financial markets. Any new solution for non-CLS currency may not rise to the same level of systemic importance as CLS, at least not initially, but will need to be mindful of a potential future state where the solution may breach systemically important thresholds. Consideration should be given to what standard should apply, the existing standards that apply systemically important FMI, the PFMI, new standards, or adaptation of the PFMI. The guiding principle is not to dilute standards that are served FMI well, but to ensure standards are not an absolute barrier to mitigation of risk. The key question, and a question that will need to be asked repeatedly over time as the market's use of any such solution evolves, is what risk management practices are required given the scope, nature, and size of the activity performed. These are just some of the many questions that will require an agile and flexible approach when developing a new solution for non-CLS currencies. While a lot of attention in this space has been given to the potential of private stablecoins or central bank digital currencies, these are simply a way of delivering payments. These options do not detract from the fact that a comprehensive payment solution covering the elements I just outlined needs to be considered as a matter of policy. CLS welcome further discussion on these issues. To conclude, we must decide quickly if a new and different type of model is the preferred path forward over no solution at all. Right now, we are at a pivotal crossroad. We can choose to actively pursue a solution for this threat to the financial stability or stand by and do nothing. The choice is clear to me. I am calling on the industry and regulatory community to form a new public-private partnership similar to the one that created CLS in 2002. This partnership should build upon the GFXC's effort to promote PVP adoption and importantly agree to solutions for non-CLS currencies. The path forward is not a smooth one. Complex questions require answers and compromise need to be made, as I illustrated earlier. A successful cross-border solution will be wholly dependent on the strong global cooperation. Partisanship and policy must be avoided. The key question is, are we up to the challenge? Given what is at stake, we must be ready, and I know we are ready. CLS and its operation today are evidence that when the industry and the regulatory community work together, the financial market toughest challenges can be solved. Thank you very much for your attention.
Thank you very much for this very interesting and very informative presentation. I would have one question about CLSnet. I mean, could you tell us a bit more about CLSnet? What is the role that CLS will perform in this service? How many banks, how many currencies will be concerned?
So CLSnet, a priori, has no limit today. Is a service which is provided to the banks to be able to calculate bilateral net positions among themselves on pair of currencies, which they are settling outside of the 18 currencies which are settling within the core services of CLS. CLSnet, therefore, is helping to identify risk that banks are carrying on those transactions they cannot settle through the normal service. By having the idea, as I propose in my presentation, to think of bringing PVP solution for those transactions, we would be able to bring an additional step in the mitigation, not only identifying bilateral position, but being able to settle them in a safe PVP context.
Okay, thank you very much, Marc. I mean, earlier this week, Victoria Cleland spoke about the efforts that central banks are making to enhance cross-border payments globally. Can CLS contribute to this effort beyond PVP?
Yeah, absolutely. I think the work done by the CPMI and Victoria group in particular is really very interesting, as identify a lot of challenges. Some of them we recognize quite well, because when we are setting up new currencies in CLS, we are confronted to similar barriers. They have identified, as you know, different areas, 5 areas exactly of focus. And I think CLS can help on quite a few of them. In particular, I would say on the so-called area C, which is looking at PVP and therefore at settlement challenges, where really here we can help to understand, to contribute. But there is also very interesting building blocks around the areas on the regulatory context and the necessity to have appropriate oversight mechanism for cross-border institution. So obviously with our oversight committee, we have quite some experience on that. As I was mentioning it's one of our, I think, assets to have such a strong oversight with the central bank committee, as well as looking at the last element, which I understand will be discussed a bit later, whether a new way of circulating money with digital-based mechanism could be also helping in being more efficient in this space. So more efficiency in the cross-border payment is good for the development of safe, I would say, foreign exchange also.
Thank you, Marc. I would like to jump on what you said. I mean, today's discussions in the conference are mostly on digital currencies, stable coins, Libra, central bank digital currencies, and so on. Is there a role CLS can play in this respect?
Well, CLS is in between the FX. So as soon as you have FX settlement to be taking place, or the capacity to be able to make payment in different central bank money, which are being exchanged, yes, CLS has a role. So depending on the way those initiatives are going, it could be that relying on a partner like CLS with helping the industry to be more efficient can help to define appropriate processes, and eventually also can help in having a unique capacity, I believe, today, which is to generate payment in central bank money in multiple currencies through our system. So we certainly have a know-how, and being in the middle of the market infrastructure, getting the trust of the ecosystem is one of our features.
Thank you, Marc. I'm thinking about, I'm anticipating on next year's Central Bank Payments Conference, which hopefully will take place in Cape Town in June, as we do expect. What kind of progress can we expect to be done by the regulatory agencies, by the central banks, and by CLS, and by the market in the topics, in the problems that you have mentioned today?
So I have no crystal ball, to be fair, but as I mentioned in my presentation, there is different dimension to it. One where I believe we can move relatively quickly because we have already a positive feedback is this element of getting a common understanding of the challenge of the evolution of this settlement risk, and in particular to have a stronger refinement of those principles from the global code mentioning the settlement risk. So the principles 35 and 50 I mentioned earlier. So I do believe that next year we will have progressed on that. When I say we, I mean the ecosystem, certainly, as well as having the possibility to see some debate around the series of questions I have mentioned for some concrete pair of currencies, where there could be already some reflection on where we can go. So by next year, I hope we will have more detail on those elements and more progress on that. And I do hope that the public, in particular of this conference, primarily central bankers, have a good understanding of this and take some time to think about all the good things we can do in bringing more stability and security in this space.
Okay, thank you very, very much, Marc.